Hi everyone and welcome to today's morning report on Wednesday the 3rd of February with me, Rich Perry, market analyst at Handtech Markets. European trading sessions got off to a relatively sort of stable-ish but slightly weak start really. There's been several drivers behind this. We had a very strong move into the close actually to the downside yesterday on Wall Street, and that was driven by this continued retracement in oil. Let me just show you the oil price. The WTI price sharply lower in the last couple of days, and that has certainly seen a retrenchment of risk appetite and move into safe haven trades. And you've seen equity markets sharply lower, you've seen treasury yields sharply lower. These treasury yields continue to fall strongly away. 10-year treasury now is at the lowest level since April last year. The 2-year as well, falling sharply away, following on from that huge run higher that it saw towards the end of the year last year, as the market sort of factored in that rate hike. But certainly that falling treasury yield on the 2-year doesn't bode especially well for the expectation of further interest rate hikes in the States. But what we have got is just generally speaking this slight bit of support today. And that's come as the oil prices bounce, but also we've had data out from China overnight, the services sector PMI coming in at 52.4, which is a 6-month high, and that's certainly helped to sort of stabilise a bit of sentiment today in these markets. So throughout the rest of the day we've got the service sector PMIs generally dominating, and let me just show you the UK service. Oh, sorry, that's the wrong one chart. UK service sector PMI, which is out at 9:30. That is expected to be 55.3, so basically sort of around about where it was last month. Not too bad there. And then let me show you the ISM data, which is 55.1 is the expectation at 3 o'clock this afternoon. That would be the lowest actually on that reading since March 2014. So almost a 2-year low on that, and that would certainly not be that welcomed, even though obviously that is growth, and sort of the trend of falling away is not especially great for growth going forward, especially considering we've got the manufacturing sector, which is performing so poorly in the States. The ADP employment numbers at 115, that tends to be seen as a bit of a harbinger, doesn't it, for the payrolls report on Friday. 195,000, which is sort of back into where it was previously. That would sort of be consistent with a fairly sort of solid expectation of a payrolls report on Friday. And finally, we've got the oil stocks. The weekly oil stocks is expected to come at 5.0 million, so another big build in oil inventories. That's certainly not going to help the oil price today. So this little bounce that we've got in oil at the moment may come under a bit of pressure, you could possibly see. Now, my chart of the day is the Aussie dollar. Now, the Aussie has been in this nice trend higher, completing a base pattern actually, but, and I say but, that trend higher has been broken, and that breakdown in the trend is a bit of a disappointment really. It certainly suggests that this big bear candle that we had yesterday is sort of putting the pressure to the downside. Now, we've had a pretty strong recovery actually since the day low already, that day low coming in at 0.7 big figure. So you've already had a 50-60 tick rally on that move. Now, that is interesting because we've seen a Kiwi strength today on the back of better than expected employment data, and also sort of comments from the central bank that they weren't going to be cutting rates in March, or was unlikely to cut rates in March, and that certainly seems to be sort of filtering through into the Aussie a bit today. But certainly the technicals are coming under a bit of pressure. The sort of rally that we've seen, the unwinding rally, back into a level at which round about where we start to see the resistance coming in, the sort of the RSI falling over generally around the sort of mid-50s point. The stochastics crossing lower. Last time we saw that, beginning of Jan, we saw the big sell-off, and previously to that we also saw weakness in December as well. So these indicators are beginning to suggest that possibly we're starting to see a bit of a correction back lower again on the Aussie. Now, this hourly chart certainly shows that uptrend is being broken, And not only that, we've seen this rally back to the uptrend. Now that could well start to find a bit of resistance. Already we've seen the outlook on the hourly momentum turn a bit more negative. 30 was hit, or just below 30, and if it starts to roll over again around the 60 point on the hourly RSI, that would be a negative configuration as well. So we're looking out for this resistance possibly coming in around that the underside of that old uptrend. Got minor resistance around 70.75 before the 71.40 reaction high that we saw on the 29th, which was last Friday. So could be that we're seeing a slight deterioration in this Aussie. Now you've also seen a completed top pattern, you could argue. If I zoom out, you can see a bit better. You've got a double top there, and that gives you a sort of implied target, or certainly a move back down to 69.60, I think it is. Gives you about 90 ticks of correction down from 70.50 area, which was that neckline. So that gives you about 69.60 of target. So possibly that's another reason why we could be going lower on the Aussie. But a little bit of an interesting turnaround in the Aussie in the last day or so. So I wish you good luck in your trading, and I'll speak to you later. Thank you.